Okay.
Hello, everyone. Thank you for joining our webinar. I think we're just waiting for one or two attendees to arrive. Give them another minute or so, and then we will get started. We have about a 15 to 20-minute presentation for you. Happy to take any questions that you have. And so if you're familiar with the go-to webinar setup, then there's a chat box that you can send a private message to myself, Doug Edmonds, or Chris Antipa, who is also listening in on the webinar. So it looks like we've got we're correct, so we will start through our presentation. So
let's just wait one more. Let's give it one more minute, folks, as we get some more people are jumping in here. And again, thanks for making the time. This is our first effort here, so apologies for any kind of snafus on the technical front, kind of moving in. So again, any questions, feel free to ping the chat. Obviously we wanted to set this up to help preserve the anonymity of all participants on the call. So so thanks for your patience.
Okay, we're just going to get right on with this. So this is a presentation that we pulled together for the Neudata conference in London last week. I know some of you were there and might have seen the session or missed the session. I thought I'd just give you a reprise of sort of the context. So we're presenting in it's all about the consumer sector and how can we understand the consumer sector using transactional data. The moderator had made a reference to sharks, so we sort of echo that. How to swim with sharks safely is sort of like the premise of this particular presentation. And for those of you who are less familiar with what we do, we sort of like work closely with retailers, and the exhaust of our business we then package up and sell as a couple of different data products to firms in the investment management space. So we don't deal with manufacturers, so we tend to sort of work with those two legs of the stool that are on this slide. In terms of data scope, we've got 13 years of transactional data, 260 plus public firms. We map those to ISIN. They are delivered on a daily basis, and we also have some promotional data. We have 6 years of promotional data, so promotional price by store by day, also mapped to an ISIN for those public firms. So you can get an understanding of what public firms are trying to do and how the consumers respond. So the question really is why alternative data? Well, why any data? It's all about the story. It's all about informational surprise. So how do we go about using this data to identify the story? Well, simplistically, it's about looking for obvious features and looking for non-obvious features. So in this case, we've used a couple of case studies where we can sort of identify what the obvious features are. Do they help tell a story, and then compare that to some non-obvious features. And really it's about helping people unpack what these non-obvious features might be, because I think by definition everybody gets access and knows what the obvious features are, but the real story and informational surprise is probably more likely to lie in these non-obvious features. So we've got two case studies. We have case study one. We have a private company performing an IPO, and this was in 2019. So we have a little look up at the sales run up before the IPO, and to see how the share price reacts to various sales events, and to see if we can tease out a correlation. And it's worth like pointing out at this stage, obviously, we've used the power of hindsight to understand and look for patterns. So with like pulling out a narrative rather than using all the data we have to perform an exhaustive statistical analysis and sort of like look at the predictive power of the features. So this is just giving you a flavor, an overview of what we have. And then the second case study is where there's a public company which acquired another public company back in 2018, and this led to quite a lot of acrimony in the shareholders of the acquiring public company, and I think there's an ongoing class action lawsuit against the acquiring firm because it didn't perform its due diligence. And really what we're trying to do using our two data sources is that was there anything that we could observe prior to any earnings calls? Now, this isn't to say that these will be, predictive on a mass scale, but they're certainly strongly indicative. But we will get into that. So before we sort of get into the detail of it, it's worth thinking about this from a manufacturer point of view, and that sales growth is hard. These markets are in dynamic equilibrium, so everybody is chasing the same growth. And if sales growth was easy, then everybody would grow, and arguably no one would grow. So there's this like a trench warfare and entrenchment that exists, and in part it's because everybody is competing for finite space or something that's finite, whether it's incremental dollars, incremental shelf space, incremental warehouse space, or even incremental page space on an e-commerce page. So it's all about competing for that space, and because it's finite, we tend to see this quite hard to see growth. Added onto that, we have the ideas that form behavioral economics. So this is the psychology of consumer decision making, and what this tells us in a nutshell, if you're unfamiliar with the term and the thinking, is that customers tend to be habitual. They do today what they did yesterday more often than not. So it's hard to get them to try new things, and they're also irrational. They don't necessarily do things which will benefit them and only them. So they don't necessarily always buy on price. So the context of the sort of the retail environment is that firms need to incentivize behavior change. So it is very hard to grow for a number of reasons that we've listed here. And so firms need to work hard to drive this growth. So we're going to start with some obvious features, and we'll speed over these relatively quickly, but it's worth calling them out just for sort of reference sake. So the obvious features in the data set, if you're looking for firms that are trying to grow and that are achieving this growth, is looking at the number of products that a firm has listed. So is this firm investing in innovation? And if it is investing in innovation, is it then getting these new SKUs listed in stores? So this is obviously a key part of the sales funnel. They need to sell in their products to retailers, and if there's a compelling story, then the retailers will list them. And here we have the firms then competing and winning some of that finite shelf space. In addition to that, and alongside, is that the number of stores featuring any product from a particular manufacturer. So are they increasing their distribution? So if they're increasing their SKU count and increasing their distribution, then this is a way of they're increasing their TAM, their total addressable market. But as I said, these are obvious data features, and they tend to be sort of, in quotes, air quotes, priced in, because they very quickly become public when Coca-Cola or Monster Energy or Kellogg launch a new product, a new variant. Is very much PR'd, and so ahead of time people know that there's a new product coming down the pipe, and that will be factored into sort of like any correlations with share price. A more obvious feature than distribution and SKU counts is looking at sales and market share, and here we have we're getting into our first case study. So this is referring to the IPO. The firm was private up until May, early Q2 of this year, 2019, and then it performed its IPO. And here we have the daily dollar sales from our Odyssey 2 panel of that manufacturer across all of its products for 2019 up until around the 23rd of August. And the notable features on this slide are the red line showing the fluctuating daily sales peaking on a Saturday, and they hover and oscillate around a one mean prior to the IPO, and then about 2 weeks before the IPO takes place, they gap down to a new mean, and they oscillate around that for the most of Q2 before rising as we approach July 4th and the holiday season. So, you know, a bit of a gap down in sales. And when we overlay share price onto this slide, and obviously sales is just going to be one driver of share price, and there was certainly a lot of exuberance around this particular stock when it was launched. So as we see from launch, the share price tracks up. Q1 earnings take place towards the end of Q2, and the share price tracks up again. And then when we get towards Q3, mid Q3, the Q2 earnings take place, and after this, share price starts to move down. And since then, we know that the share price has also lost further gains. And so one might look to daily sales, one might look to, like, you know, rolling sales and total dollar sales to see if this is an obvious feature that is going to be indicative of future share price movements. And as you can see, there's not there seems to be not a great deal of correlation between the two, even by eye. So sometimes sales and market share is being an obvious feature isn't necessarily going to tell you the story. So we're going to move on to some non-obvious features. Again, still looking at this first case study, and the non-obvious feature we're going to display first is what I call average item price. So we take the total dollar sales and we divide by the total unit sales, and this gives us the AIP, the average item price. And we put on here a 3.5-year time series of this particular firm. And as you can see, there's a couple of features that we've pointed out. So the first one on the left-hand side, Q2 2016, we see a deep trough in AIP, and that is a price promotion. So it lasts for maybe 4 weeks, 3-4 weeks, which is typical of a price promotion, and then it quickly reverts. When we get into 2017, we see a lot of fluctuation, and this fluctuation happens as the sales mix changes. And as the sales mix changes, we see the AIP effectively move up to a different mean because new products are launched at a slightly different price. Unit sales shift between the products on offer, and the AIP fluctuates and moves. And then at the end, we have what I would call an extended promotion. And in this extended promotion, we see that the average item price drops and remains low for quite a long series of time. And when we sort of move into that and zoom in on that, which takes place in 2019, we can start to see if there's a potential overlay. So we've just shown here the share price with Q1 earnings and Q2 earnings labeled, and then we're going to bring on the average item price. And one interesting thing about this feature is that prior to the IPO, if we recall, sales went from one mean to a different mean 2 weeks before the IPO. But when we express that change as in terms of look for that change through the lens of average item price, we see a 12% drop in that AIP prior to the IPO. And of course, this signal is obscured from the public when the results are announced in Q1, because for most of Q1, the AIP was tracking high. But when the Q2 earnings are announced, and then sort of the economics of the business for that latest quarter are revealed, and yes, their year-on-year quarterly results were showing strong growth, but what they've effectively done is they've bought their customers. They've altered the economics of their business, and this is one of the factors which has helped like, you know, drive down the share price. And the important thing to note is that we would have been confident in this signal for at least 4 to 8 weeks prior to that earnings call. Using average item price, you could see that this was a promotion that was running longer than a typical promotion and is materially going to impact how this firm is generating gross profit and, as a consequence, earnings. So we would say that average item price in this instance is a non-obvious indicative feature. We're going to look at the second case study now, and here we have the 5-year sales ramp up prior to an M&A announcement which took place at the end of June in 2018. And so you can see it's like steadily increasing rolling 4-weekly sales, some fluctuations around key selling periods, and then following the M&A announcement, we see a decline in rolling 4-weekly sales, which is unusual and has been commented about in the press. One feature we can also look at using our Atlas 2 data set is the number of products that are on promotion per week. And so we've overlaid this on the same slide. And what you can see is that there's a clear link between price promotions increasing and rolling 4-weekly dollar sales increasing. And here we have in red a high number of promotions in the first half of 2013. Between middle of 2013 and middle of 2016, they stay relatively low, and then they ramp up again towards the end of 2016 and stay high. And we did some digging. We tried to find out why they decided to change their promotional strategy. In 2016, they were achieving some growth, it looks like, and the only one of the major factors that we discovered was that a new CEO arrived at this firm in late May of 2016. So they get their feet under the table for a couple of months, and then towards the end of 2016, the new strategy is rolled out, more promotions, and dollar sales start to ramp up. Unit sales and dollar sales start to ramp up. If we focus in on the 3 years of 2017, 2018, and 2019 to the end of August, we can start to see, in detail what might have happened. So in that previous slide, we saw the number of items on promotion, so reduced price, was significantly higher through 17, 18, and 19. And when we overlay the average item price for the first half of 2018, it's $2.69. And when we look at the average item price for the second half, it's $2.90. So what we've discovered here is a firm that has used price promotions to drive up its business. And as a result, it has taken a margin hit. And then as soon as the deal is announced, the prices revert back to their normal level. So we see the average item price increase and dollar sales take a hit. And the CEO of the acquiring company described these deals as highly inefficient. The acquired firm was chasing volume over value. And what they'd done, the firm in question, they had stuffed the channel. They had got the retailers to take on more stock than they normally take, and then they'd use price to drive through unit sales, hoping to get some efficiencies on the back end. And in some ways, their strategy was successful because the firm was acquired, sales grew, the firm was acquired. But then when the new firm starts to unpack what they've acquired, they start to see that they've been selling the brand short rather than investing in the brand and in innovation. and this sort of forms the crux of the class action lawsuit from shareholders, which I think is either settled or ongoing. So the second case study, we clearly see weekly promotions, again, a non-obvious indicative feature. And as with the average item price for the brand that performed the IPO, we would have known well in advance that the firm that was acquired had been using, this financial incentive to drive its sales, which was unsustainable and was going to have potentially an impact on the margins it was making, and hence its earnings. So in summary, how do we set up the radar? How do we roll this out or how can this be used for other firms? And other use cases. Well, here we have some indicators of what we call informational surprise that are captured in our data. So looking for sustained price changes. Typically promotions run for 2 to 4 weeks. If you see promotions that are running for a longer period, then clearly there's some like short-term strategy at play, which will be successful in the short term, but in terms of driving earnings up, it's unlikely to be sort of particularly profitable in the future. Looking at increased store distribution, which we touched on briefly, it is an obvious feature, but it's not always. Once a retailer decides to list a particular product, then each new division or region or store that the product is listed in isn't necessarily included in the press release. So there might be some information that's captured there. Again, we can talk about better quality distribution. So what are the average dollar sales of stores that your brand is currently listed in, and what are the dollar sales of the stores that it will be listed in? And if that second number is larger, then you know that a product is being listed in bigger and bigger stores, and with more traffic, more customers, more dollars to spend, and so sales may go up as a consequence. Increased UPC count. Are there new products being launched? How do those new products perform relative to the existing products? And finally, looking at reduced shelf voids and out of stocks. Is this firm, our manufacturers, capturing on the demand that exists in the marketplace at that point in time? That's it. If you have any questions, feel free to sort of drop them through on the chat, or email them through to Chris. We're going to be running these webinars, periodically, and I think the next one we'll start to look at some of our video game data. Obviously, video games earnings season is Q1 2020, covering the peak period which we're in now. So we'll start to aggregate and summarize some of the findings that we're getting in our Orion product. But if you've got any questions, then please shoot them through, and we'll hope to answer them.
Yeah, doesn't look like we have any questions.
Thank you very much.
So thanks again, everybody, for attending. Again, this is the first time that we've done this, and as Doug mentioned, we've got some thoughts about doing some other content down the road. So if you have any high-level feedback for us, we're more than welcome to take it if you're kind enough to give it. So thanks a lot for your time.
Thank you. Bye.